Have you ever stopped to think about how much your address, where you live or run your business actually affects your finances? It's way more than just a spot on the map. It can seriously be a core part of your whole financial plan. Today, we're doing a deep dive into something often called America's tax haven states. We've been looking into this and found some really, really insightful material explaining why certain U.S. states are, well, so attractive for managing wealth and planning finances strategically. It's fascinating stuff.
Yeah, it really is. And our mission here is basically to pull out the most important bits of information from what we've gathered. We'll look at which states offer these big tax advantages, what those advantages are exactly, and crucially, how they might apply differently depending on your specific situation, whether you're, an individual or a business. Plus, we need to touch on the legal side, the practical things you have to do, and importantly, what other taxes might still be waiting for you, because it's definitely not just about income tax.
As we started digging into this, one of the first things that just jumped out was that huge incentive. Zero state income tax.
Yeah.
On wages, dividends, interest, even capital gains for individuals. It's a total game changer. Think about it, someone earning, say, $1 million a year, moving from a state with a 10% income tax, that's potentially an extra $100,000 every single year.
Exactly. That's a huge amount. And that kind of money really adds up over time, especially if you're a high net worth individual or maybe an entrepreneur or retirees living off investment income. And it's not just personal savings, though those are obviously very appealing. What's also key is how it cuts the overall tax burden for businesses, especially those pass-through entities like S-corp, partnerships, sole proprietorships. It boosts their net profit directly. So it's not just a perk for individuals, it gives businesses a real competitive edge if they plan it right.
Okay, so let's zero in on that income tax point. What really makes these states stand out the most? Is it purely that lack of state income tax?
That's definitely the headline act, you could say. The power of having no state personal income tax is, well, it's the main draw, no question. Just think about the difference. In states like California or New York, the state income tax rate for top earners can easily be over 10%. But residents in these no-income tax states, they can legally keep that substantial chunk of their income away from state taxes.
Right. And that must translate directly into more money in your pocket, higher net take-home pay.
Yeah.
And for those businesses we mentioned, the pass-through ones, setting up shop in one of these states could mean, wow, enormous tax savings, a direct boost to their bottom line.
Precisely. Now, if we look at the map, our research really highlights 9 specific places, 9 states or jurisdictions. And interestingly, beyond just the zero income tax, each one has its own kind of unique flavor, additional appeals. Maybe we can run through some examples.
Yeah, let's do that. Which ones stand out?
Okay, well, take Alaska and New Hampshire. They're interesting because on top of no state income tax, they also generally don't have a state sales tax in most areas. Alaska even gives residents that annual permanent fund dividend, from its oil money. And New Hampshire, it's phasing out its tax on interest and dividends, should be totally gone by 2027.
Okay, so no income tax and no sales tax in most places. That's pretty attractive.
Definitely. Then you have states that have become real centers for wealth management. Florida is maybe the classic example, long been popular with retirees, right? It also has strong asset protection laws, no estate tax, and it's a major financial hub now. And then there's South Dakota. It's really emerged as a major player in trust law. Very flexible, very creditor protective trust rules. It's become a go-to for things like dynasty trusts.
Dynasty trusts, what are those exactly?
Good question. They're basically trusts designed to hold assets for many generations, often skipping estate taxes along the way. South Dakota's laws are particularly favorable for setting those up.
Got it. Okay, what about businesses? Any states particularly friendly for them?
Absolutely. Nevada and Wyoming come to mind immediately. Nevada is known for being business-friendly, popular for setting up companies, especially LLCs and asset protection trusts. Wyoming, too. Minimal corporate taxes, another great place for LLCs for asset protection, estate planning. It always ranks really high for ease of doing business.
Right. And we hear a lot about big moves to Texas lately.
Yes, Texas. It's an economic powerhouse right now. Booming economy. Zero state income tax. It's a magnet for both people and companies. You mentioned the big names, Tesla, Oracle. They've moved or expanded there significantly. It's hard to ignore.
Definitely.
Then there's Washington State, also no state income tax. Now, they do have what's called a business and occupation tax, the B&O tax, which is on gross receipts, so businesses need to factor that in. But for individuals, especially, say, tech workers in Seattle, not paying state income tax on their salaries is a big plus.
Okay. And Tennessee?
Tennessee.
Yeah.
Right. As of 2021, they got rid of their last bit of income the Hall tax on dividends and interest. So now it's completely income tax-free. That's made it really attractive, especially for retirees and investors looking to relocate.
Okay, wow. So that's 9 states, each with its own angle beyond just the zero income tax. So let's connect the dots here. What does this all actually mean for you, the listener? How does this translate from state policy into someone's real financial life?
Well, the crucial thing to grasp is just the scale of the savings. We mentioned the $100,000 example earlier. For people with significant income or substantial investment earnings, saving even a few percent on state taxes year after year, that can add up to millions over a working life or retirement. It's not just small change. It's serious wealth accumulation potential. Money you keep, money you can reinvest.
And for businesses.
Yeah.
Especially thinking about startups or maybe companies that are mostly online or remote. Choosing one of these states seems like it could seriously cut operating costs and boost what the founders actually take home.
Exactly. It becomes a strategic decision. It can genuinely affect a company's growth path, its profitability. That's why you often see wealth managers, tax lawyers, estate planners recommending relocation. It's often part of a bigger long-term financial strategy for their clients.
Okay, but here's something that really caught my eye in our analysis. It sounds like it's not quite as simple as just buying a condo in Florida or setting up an LLC in Wyoming, right? You don't automatically get all the tax benefits just by doing that. What are the catches? What about these domicile and residency rules? Are there traps people fall into?
Yes. This is super important because this is where things can go wrong if you're not careful. Simply owning property or having an LLC there isn't enough. The key concepts are domicile and residency and the rules. They vary quite a bit from state to state. And you have to remember, the high-tax states you might be leaving, think California, New York, they are known for being pretty aggressive. They actively pursue former residents to make sure they really left for tax purposes.
So they'll audit you, basically, to see if you genuinely moved.
They can, yes. They look for evidence. Did you truly establish a new permanent home? That's why a well-thought-out relocation plan is absolutely essential. It's much more than just forwarding your mail. We're talking about changing your voter registration, driver's license, car registration, getting a new primary mailing address that you actually use. Crucially, it involves time, spending a significant amount of time physically present in the new state. And often, selling your main home in the old state is a big factor in proving you've really cut ties.
Okay, so it requires real commitment and proper documentation.
Exactly. You need to demonstrate clear intent to make the new state your permanent home.
This leads to another really critical point from our findings. Do these benefits actually apply to everyone in the same way? It seems pretty clear that your citizenship and residency status really matter here. The impact isn't uniform at all. Maybe we can break that down. Let's start with U.S. citizens and green card holders.
Sure. So for U.S. citizens and permanent residents, people with green cards, the general rule is if you properly establish your legal domicile in one of these no income tax states, you typically don't pay state income tax on your personal income. And that's often regardless of where the income is technically earned, although there can be nuances with sourcing, which we'll touch on.
And establishing domicile, like you said, means more than just owning property. It's voter registration, driver's license, where you spend your time, proving it's your true home base.
Precisely. And for business owners running things like S-Corp or LLCs, if the business is genuinely headquartered and mainly operating in that no-tax state, its income usually avoids state income tax too.
Okay. What about non-citizens who live here, resident aliens?
Right, resident aliens. These are folks who aren't citizens but live in the U.S., typically because they meet the substantial presence test. That's a calculation based on days spent in the U.S., or they have a green card. Generally, they're taxed much like citizens. So if they legally reside in, say, Florida or Texas, they usually get the same state tax benefits on their income. No state income tax.
But are there complications?
There can be, yeah. Complexity creeps in if, for example, they split their time significantly between states. Or, importantly, if they earn income that's sourced to a state that does have income tax. Think about your example earlier, living in Florida but owning a rental property back in California. That rental income, California will likely still want its state income tax because the income source is there.
Ah, okay. So where the money is earned still matters, even if you live somewhere else.
Exactly. State sourcing rules are key.
And finally, what about non-resident aliens? Foreign nationals who don't live in the U.S.?
Okay, so non-resident aliens. These individuals are generally only taxed in the U.S. on income that comes from U.S. sources. Since they don't actually reside in the U.S., they don't benefit from living in a no-income tax state in the way a resident does. The concept of state residency tax doesn't really apply to them directly.
But could they benefit in other ways, like if they own a business there?
Potentially, yes. If they own a business or property, or maybe set up a trust or an LLC in one of these no-tax states like Nevada or Wyoming, they might get favorable state-level treatment, but typically only on income that is specifically generated within that state. Again, those state sourcing rules become absolutely critical to determine where the income legally originates.
Okay, that distinction between residency statuses is really important to understand.
It really is. Now, related to that, we need to address something else. Just because there's no state income tax, does that mean you're totally off the hook for state taxes?
I suspect the answer is no.
You suspect correctly, no. State income tax is just one piece of the pie. A big piece, for sure, but only one. Many of these states make up for the lack of income tax in other ways. You might find, for instance, pretty high sales taxes, think Tennessee or Washington.
Right.
Then there are real estate and property taxes. Depending on the state and the value of your property, these can be quite significant. You've also got excise taxes, things like taxes on fuel, alcohol, tobacco. Those are common everywhere. And some states, like Texas we mentioned, have franchise taxes or gross receipts taxes on businesses, which is different from an income tax but still a state levy.
So even in a no income tax state, your total tax burden really depends on your spending habits, what assets you own, your overall lifestyle.
Exactly. It's not automatically lower overall taxes for everyone. You have to look at the whole picture.
Okay, so wrapping this up, the clear message seems to be that strategic planning is absolutely essential. Making a move just because of the zero state income tax headline, that could be a mistake if you haven't considered everything else.
Definitely. It requires a really thorough understanding.
You need to get your head around the difference between federal and state taxes. Nail down those domicile and residency rules for the specific states you're considering. Understand how income earned across state lines works that sourcing issue. Plus, think about the knock-on effects for your estate plan, how your business is structured. It's complex.
It absolutely is. It's really not a one-size-fits-all kind of deal.
So, the advice that came through strongly in our research is what? Talk to an expert.
Yes. The best first step, really, is to consult with a qualified tax advisor, and specifically one who has experience with multi-state tax issues. They can help you figure out if your specific financial profile actually lines up with the potential benefits of moving to one of these states, and crucially, help you navigate all those complexities we've talked about. Help you choose the state, if any, that's truly suitable for you.
That makes a lot of sense. It's about making an informed decision tailored to your circumstances.
Precisely. And you know, what's really fascinating looking ahead, for people in higher income brackets or those running growing businesses, state tax policy clearly has this huge potential impact on their long-term financial success. And with our economy becoming so much more mobile remote work, digital businesses, it seems likely, doesn't it, that even more people and companies are going to explore the unique financial breathing room these states offer.
That's a great point. It prompts you, the listener, to really consider how these insights might fit into your own financial planning or your business strategy. Could this be relevant for you? It might just offer a new perspective or even a potential path forward. All the best, and we will meet again with another important subject in the next meeting.